Hello, viewers. Welcome once again to Nick Insurance TV. My name is Nicolina Na Yeye Adumwa. This is the platform where we explain insurance terms and conditions and the benefits of insurance, which will be very, very important for you to know as you plan to take up an insurance policy or as you have one already. We've been talking about life insurance and some of the terminologies and the life insurance policies. Today, we want to discuss a few more to help and to guide us understand and appreciate the policy better. So, when we talk about reinstatement, what are we talking about, or what does it mean to reinstate a policy? This is simply to revive the policy that have gone into lapse for a period of time. So, for instance, you had a little challenge with money, so you couldn't contribute or pay your premium over a period of time. This policy, we say in insurance, has lapsed. So once the policy lapses, it means that there's no contribution or this premium is not coming. However, if you are okay and sound and you have funds and you've gotten a new job, you want to revive the policy, you have the right to do that. The insurance company will gladly revive your policy for you. And this is what we call reinstatement. Of course, it comes with its terms and conditions, and one of it is that yes, you will pay the backlog that you have created by not paying the premium. The responsibility of the insurance company is also to make sure that they put a document on your policy saying that yes, they are reinstating the policy and reviving the policy for you. Now, there's something called settlement. These settlements is the conclusion by the insurance company that yes, we have to pay your amount of benefit, that is either the maturity benefit or the net surrender value that you're paying to you. These comes in different forms and there are various modes of payment. For instance, if you have done a policy called annuity, you can agree with the insurance company to pay a lump sum to you, or you can agree with the insurance company to pay you monthly. There are various modes of payment, and this will be per your agreement with the insurance company. Somebody can say, pay me every 6 months after the maturity of my policy, because they do not want to spend all the money that might be given to them as a lump sum. Then you hear things like sum assured. What does it mean? The definition of sum assured is basically the insured amount on a policy that is agreed at the inception of the policy that the insurance company will give to your beneficiaries at the time of your demise, or as you agree with the insurance company. That is what we call the sum assured or sum assured. Now, this sum assured or insured can be adjusted annually to take care of inflation and the economic situation at the time that you will need to assess this. And so, if you pick an annual adjustment of 5%, what it means is that every year at the anniversary of the insurance policy, Assuming you took a policy in April, every year, April, that becomes the anniversary of your policy. And therefore, the anniversary at the anniversary time, your sum insured will move a notch higher by 5%. And this is what it means. Then we talk about surrender benefits. This is the accumulated funds less the surrender charges. You remember we spoke about some charges that accrued on your funds as you contribute. The administrative charges, for instance, the charges into risk, for instance, are all charges that are applied to your policy. And when you say you're surrendering the policy, you don't want to do anymore, these charges are taken off, and then the net surrender value is given to you. So we ask on this show, insurance, what do you know? Next week, we will dive deep into other areas. God bless.